Good afternoon, and thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research at Red Cloud Securities, and I'm delighted to host another Red Cloud webinar on uranium today. So we are going to hear from Peninsula Energy MD and CEO Wayne Heili, somebody I've known for at least 15 years or so. Now, during today's webinar, he will provide he'll go over today's new mine plan and outlook, and then he will take your questions. You can type your questions into the chat box at any time, and we'll get to as many as we can. Before we kick things off, first we need to discuss the fine print. During this Peninsula webinar, forward-looking statements may be made. I direct listeners to its forward-looking statements outlined on page 2, 3, and 4 of its corporate presentation. That can be found on the company's website, pel.net.au. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation of buy or sell securities. We note this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. So please see our most recent research, which actually came out earlier today, located on the Red Cloud website for specific disclosures on Peninsula. So with that said, why don't I turn the floor over to Wayne to speak about the company? Take it away, Wayne.
Well, thanks, Dave. First and foremost, for those of you who are planning to join us yesterday and got a last-minute notification of a change of agenda, I do appreciate you joining on today. Peninsula had this pending release about our plans for a revised life of mine plan, which is going to see us restarting the Lance projects in 2024. And it just ultimately made more sense for us to put it off one day rather than wait or go ahead with the webinar and not be able to share this news. So our latest release is on our website, and it's available in the media. Thank you, David, for picking up some coverage on that and sharing your insights into it. Today, I'd like to spend a few minutes to share the company's view on the exciting prospects for Lance and how Peninsula Energy is going to move forward to put this globally significant uranium project back into production. Thanks again, Dave, for covering off on these disclosures. It would take 10 minutes of my time to read them, and that's not a good use of your time. Peninsula Energy is an ASX listed company. We're listed on the Australian Stock Exchange under the symbol PEN, and we also trade on the OTCQB under the symbol PENMF. Our flagship project is the Lance project. It's situated in the state of Wyoming, U.S. That's where I reside, and it's one of the largest U.S. uranium projects that's known. We have a JORC compliant resource of 53.7 million pounds. That's measured, indicated, and inferred combined, as JORC allows us to speak that way. We have prepared a robust production plan. We've detailed it, and it's resilient. It has a good life of mine. The plan speaks to the Kendrick and the Ross production areas. And again, we plan to start operations in late 2024. That's really part of the new piece of news that came out yesterday / today. We've planned to expand our production facility and create a 2 million pound per year end-to-end dry yellowcake production facility. And exciting, with that facility as the backbone, we can move to positive cash flow generation on a sustainable month-to-month basis within the first year of going back into production. So by the middle of 2025, we expect that the company producing will be generating sustaining positive cash flow. We're implementing the low pH in situ recovery process rather than the alkaline in situ recovery process, which has been adopted by every other North American in situ recovery project. We think that's going to give us a distinctive advantage, as really low pH is far more effective, and it's the world's leading producers utilizing the low pH in situ recovery method. So we've tested it and proven it to be very effective on the ore at the Lance project, and we're excited about bringing low pH in situ recovery to North America, to the United States. The Lance project is more than the Ross and Kendrick areas that we've done our life of mine study on. We have a significant portion of it called Barber that has tremendous resource growth potential, and we're very excited about the prospect of doing further exploration on the Barber project area. Finally, I just want to mention Peninsula has one of the top teams in North America in the in situ recovery space. We have over 200 years of direct operating and production experience in situ amongst our team, and it really sets us apart from others. I'm really proud to be a part of that team, and happy with the great support I get from the talented and experienced team at Peninsula. So before we get into the details of the life of mine study that we just released, I'd like to highlight that Peninsula also is respectful of our customers' requirements. European customers, particularly fond of ESG credentials. Last year, 2022, we launched our inaugural sustainability report built around the pillars of employees, environment, social, and governance. That report's available online, and we'll be releasing the 2023 edition of the sustainability report with our annual report coming up in September. So look for that. As an overview, we have 1.2 billion shares on issue, and had a little slide in our share price overnight, but we're giving you the most recent share price. Our market capitalization, about $115 million Australian. We have no term debt. We have $21 million of cash and a uranium inventory of about 210,000 pounds, which values out at over $11 million. It's liquid and non-committed. It's a source of funding for the company moving forward. Our board of directors is listed here, and the management team, which I spoke about, with all the experiences, is also listed here. I think their names you'll recognize if you're familiar with the North American in situ recovery space. Very talented individuals. I want to tell you about the Lance projects. We talk about Lance with the Lance projects, but specifically Lance is made of three distinct project areas. The Ross area, the smallest, is our fully licensed uranium facility. It's the Ross production area. We estimate that there's a remaining resource on Ross of about 6 million pounds. 4.1 million is to be produced under the life of mine plan. We have 2 previous mine units constructed, mine units 1 and 2, and we have the potential to add 2 to 3 more mine units. Presently, mine unit 3 is under development. We have rigs working, and we have completed the monitor well installation, and we're testing the monitor wells and baseline water quality to get mine unit 3 ready for production. At Kendrick, which is really sequentially the next area that we're going to produce out of, we have about 16 million pounds, and we have submitted applications to add Kendrick to our production licenses. State regulators have looked at those applications, deemed them complete, and have submitted to us the first round technical review questions. So we're well on the way towards getting Kendrick rolled into the production area license. And that's really the Ross and Kendrick areas are the 2 areas that we've evaluated in our life of mine area. The third area, Barber, is very interesting because it holds over 30 million pounds, predominantly inferred resources, and we did not do our project economics on it. That means later on, when we do additional drilling and resource exploration on the project, we can upgrade those inferred resources to measured and indicated pounds, and that's when it's more appropriate to do project economics. But you could think about the investment that we're setting out and laying out in the life of mine plan. All of the plant capital for the central processing plant will be sunk and credited against Ross and Kendrick production. And in the future, Barber will be a lower capital expansion and extension to the life of the Lance projects. So we introduced the life of mine plan yesterday in our press release. And these are some of the key highlights from it. Really significantly, production starting in late 2024. We think we can have the plant construction complete and ready by December. Our 2025 production rate will be 1.1 million pounds per year, and that's a significant project. We will ramp the project up to around 1.8 million pounds per year using a 2 million pound per year production plant. At 1.8 million pounds per year, we'll be the largest single uranium producer in the United States using in situ recovery methods. So it's a very exciting prospect for us. Life of mine from the Ross and Kendrick areas will produce about 14.8 million pounds of uranium over a 10-year period. And again, the plant will be capable of 2 million pounds. Our licenses allow us to produce up to 3 million pounds a year. So plant capacity will be the constraining matter in the future, not the licenses. Our life of mine CapEx was laid out in detail, and I'll go through that a little more in detail. I'm excited about the all-in sustaining costs and the all-in costs. We've really been able to hold the line on a lot of things. Our direct operating cost was around $21 a pound. All-in sustaining costs, I'll lay that out for you. We've come to about $42.46. And our all-in costs are right around $50 a pound, and that's life of mine, everything. So it's a great economic outcome for the company, and I'll share that with you. I think of the greatest concern in the investment community today is where are we going to get the money, and how much money do you really need? So we tried to lay that out for you here on this slide. In our press release, we talked about needing up to $95 million of additional funding to reach the point of sustainable positive monthly cash flows, which is really, middle 2025 or thereabouts in the timing. So starting from our 2022 definitive feasibility study position where the market was looking at $60 million of need, what's changed from that 2022 definitive feasibility study to now is really that because we're not starting operations now, which was kind of the plan, we're not going to have revenue from production in the interim between now and the end of 2023. And that loss of revenue, that shortfall of revenue is the biggest driver in our cash requirements. We have to carry the project longer without revenues. Then we offset that really. We have a slower rate of spend because we're not producing, we're not spending money on operations. That comes back a little bit in our favor. We also are looking at, where sunk costs were from January to June of this year, because that was in the definitive feasibility study as spent money. So we show that here. We include our corporate costs. This is not just a project level group funding analysis, but actually a corporate level funding analysis. We require and plan to hold a cash buffer of $12.5 million so that we're not broke at the end of the development period. So we're showing, with full disclosure, that a healthy company is going to have money left over in the bank when, before they reach the point of positive cash flow. Then offsetting some of that with our cash and inventory requirement on hand, the cash we have on hand and the inventory value, it comes out that there's a net funding need around $95 million. We're going to engage government and non-government debt providers over the coming months. We're looking and working diligently on funding solutions and a pathway. We will use our existing cash. We have a fairly long runway with the money we have. We don't have to go out in the markets immediately. We have time on our side to solve the funding requirement question. And we will do that, and we will guide the market as we continue to develop a funding solution for this company. The time frame we spoke of to go back into production, really starting operational production in late 2024. Our plant has been built in 2015, 2016, and we've been working hard to modify it to allow low pH ISR operations at the plant. And that work is really essentially done now. The current plant capacity is about 0.82 million pounds per year because we have 2 ion exchange trains. We're going to add 2 more ion exchange trains, and we're going to add the back end capacity to produce dry yellow cake from the ion exchange resins. That's going to give us a 2 million pound a year plant, even though we're licensed for up to 3. The new life of mine plan really reaches steady state production at around 1.8 million pounds, and the expanded plant construction really will start this year, late in 2023. We're in the process of finalizing our selection of engineering firms and some of the advanced procurement work, like for the building structures, is already started. So, we're taking big steps. We've always planned to have the back end of the plant. It's just now that we're moving forward to expedite the construction of the back end of the plant. And we're going to do that before we restart production late in 2024. We've shared a production profile, our planning of how production will look from the Lance projects, particularly Ross and Kendrick and not Barber. Again, 4.8 or 14.8 million pounds will be produced out of Ross and Kendrick, and Barber itself holds a resource of almost 32 million pounds. So there's significant upside for this project. We've built this production profile based on very detailed studies of mining, metallurgical, and scheduling factors. And because we're so detailed, you see anomalies like the dip in calendar year 2028. And that's actually just a consequential impact of some of the technical and very real life limitations and constraints that we're facing today. It's hard to find drilling rigs today. And because it's hard to find drilling rigs for a project today, we can't advance everything ideally. And the impact shows up later in life. In 2027 and 2028, we have a dip in production. We get off to a very good start because we're developing well fields long in advance of the need. But there comes a point where the constraints that we applied in our model actually impact the production profile. But we get over that hump, and we get up to a sustained production rate of about 1.8 million pounds from 2029 and onward until the life of mine is completed. We have good production results, as I told you, in 2025 and projected, and an average solution grade of about 77 milligrams per liter. Those in the industry know that's a realistic number. That's a credible and achievable number. Really, what we've laid out is a very executable life of mine plan. The development at Lance is occurring, in our opinion, at a very opportune time. Those of you who follow the nuclear markets know that nuclear power is gaining momentum as a critical part of the green energy mix. Globally, there's a lot of recognition going into the important role of nuclear power and how it'll play into meeting decarbonization targets by governments around the world. Nuclear energy simply provides very high capacity, carbon-free baseload electricity, and every nation needs that, whether they recognize it or not. But more and more nations are recognizing the virtues and value of nuclear energy. That means that uranium is becoming a more valuable commodity in the markets. There's already a supply deficit in the markets, and there's projected continued growth in demand. So it's going to take companies like Peninsula putting their projects into production today to help meet the future needs. So, and we're excited about that prospect. The key differentiator for our company is our established uranium sales contract book. We're a junior uranium mining company that's been meeting delivery requirements since 2016. We have a sales contract portfolio for almost 5 million pounds of committed deliveries between now and the end of 2033. Our customers are major utilities in both the United States and in Europe. And in our model, we've used unescalated prices. So I share that with you. Our 2023 projection, $2023 projection for unescalated price on our contracts is $55 a pound. Now, naturally, our contracts have escalating factors in them, and we will realize higher amounts. But for our model, and this is important for people who don't always work with economic models, we didn't escalate our costs. They're $2023, and consequentially, we don't escalate our revenues either. So everything is held in $2023, constant dollars, or real dollars in our modeling. People who follow our story know we have deliveries scheduled for 2023 and 2024. And I just told you that we won't be starting production again until the end of 2024. So the big question people have is, how are you dealing with your customers' requirements? We've had important discussions with our customer base, and they recognize the recent developments with the company and our plans to bring the project to production. They've been very respectful of the delay in the production restart, and have all indicated a willingness to cooperatively revise the near-term schedule. So we feel very comfortable that our production schedule and planning will be fit into our customers' requirements, and that we'll be able to accommodate the production schedule that we're looking to achieve into our delivery schedules. Sales under the existing contracts, by the way, are about 34% or 1/3 of our life of mine planned production. That means 2/3 of the life of mine production is exposed to the uranium market, and the uranium market today is very exciting. We're seeing quite an improvement in the price of uranium. We think that the economic modeling that we have, assuming an average sales price over the life of the mine of about $67, is probably rather conservative in light of where the market seems to be going. We have that current inventory of about 210,000 pounds of uranium contract that's going to give us a working concentrate. That's going to give us a working capital option, which means that that material presently is not committed to any particular customer, and should we need to sell the inventory to continue to fund the company, that's an option for us. Finally, I'll close with this and we can go to some questions. The advantage that Peninsula really holds today is that our flagship project is located in a Tier 1 mining and uranium mining jurisdiction. The state of Wyoming in the United States is an excellent place to do business as a mining company, and particularly as a uranium mining company. The state is self-regulating the mining industry and the uranium mining industry. We don't have to go to Washington, D.C. To talk to regulators. We get to just cross the state and speak with them locally. Lance is a long life operation with excellent opportunities for exploration and resource growth through exploration. The project restart now is set for late 2024, and we expect the company will achieve a positive cash flow monthly recurring or sustainable cash flow generation within the first year of operations. Once in operation, Peninsula will be an independent, long-term, low-cost uranium producer, and will be producing the final dry yellowcake product rather than a loaded resin. Our talented and experienced team is very capable and well-suited to efficiently execute this revised plan. We don't have to add people. We don't have human resources risks. We have an established team that's capable of moving this plan forward. As I noted earlier, one thing that sets us apart is the delivery of our inaugural sustainability report. It's very important for our customers, and it's very important for the markets. We're well positioned to supply into a growing uranium market and play a role in meeting the aggressive decarbonization targets of nations across the globe. And, importantly for the ASX investors, we're the only ASX-listed uranium company providing U.S. production and direct exposure to the U.S. markets. So with that, David, I'll wrap up and take some questions.
Great. Thank you very much, Wayne. Great presentation as always here. We're now going to kick off the Q&A portion of the webinar. So a reminder to everybody online, you can type your questions into the chat box at any time, and we'll get to as many as we can. So, Wayne, I made my third visit, I think it was, to the Lance project a couple of weeks ago in Wyoming, and you already have an experienced technical team on site. You have half an ISR plant for all intents and purposes ready to go. The original plan was just to use it as a big satellite plant, but I do have to give you and your team kudos for turning that around, getting a mine update plan ready so quickly after deciding or being told, I guess, that you weren't going to be toll milling. So essentially you're fast tracking your stage 2 expansion, which was planned by year 2 anyway. So I guess the question here is, how does this new plan essentially put the production control back into your own hands?
Yeah, right. Well, as a satellite plant operator, we would be generating loaded resins, and those loaded resins then would be transported to a third-party operator, an industry peer, where they would remove the uranium from the resin, and they would produce the dry yellowcake on our behalf. Naturally, they have profit expectations for conducting those operations for us, and the transportation costs themselves of moving the resins, partway across the state. We were looking at about 100 miles each direction, were significant. So it's always been in our plans, David, to build the stage 2, what we called stage 2 expansion of the plant at the time. And because it's always been in our plans, it meant that we could very quickly evaluate and update the costs, update the timing, and get this revised life of mine plan out in under a month and a half. So yeah, while you visited us, we were hard at work. Everybody was fully focused on one of two tasks. They were either working on getting that revised life of mine plan put together, or they were working on the current construction and operations that were ongoing at the facility. You got to see a lot happening with a very busy and professional crew.
No, absolutely. Sorry to interrupt. I was just passing through. So, your old plan had you producing about 14 million pounds in 14 years, and now your new plan has you producing about 15 million pounds in 10 years. So you're actually bringing production forward with this new plan, and that should really be good for cash flow.
It is. Because of the delays in the availability of the plant, we're able to continue doing wellfield development, and we're going to have a bigger piece of brand new wellfield ready for production at the get-go. That means we can accelerate our production profile. The profile that I shared in the presentation is a much more aggressive and really a healthier production profile for our project. But yeah, we can condense the operating life of mine down a couple of years by producing at a higher rate from the very start. And we simply couldn't do that under our toll milling agreement. There were limitations on how many pounds that they were able to accommodate from our production, because they reserve a portion of their production plant for their own capacity.
Mm-hmm. And I guess to add to this point, and I'm jumping down a few questions here, but the delay allows you to complete construction of mine unit 3. So I guess what are the specific benefits, production benefits that provides using mine unit 3 instead of 1, 2 right away? And what does that mean for header houses as well?
Right. So to clarify, we did intend to have our project back in production here at mid-year 2023. And we were right at the cusp of starting up mine units 1 and 2, which were previously operated. When we produced from between 2016 and 2019, they were operated as alkaline in situ recovery well fields. We've converted those well fields and began the process of preconditioning them for low pH in situ recovery. Over the course of the last several years, we've demonstrated that we can recover a significantly higher percentage of the in-place uranium using the low pH chemistry. So the first steps for production from us were going to be to go into the old well fields that have residual uranium, do what's effectively secondary mining, and recover the residual uranium. That's not as economically robust as mining in a new well field with fresh ore. So mine unit 3 being available to us from the commencement of production means that we can ramp up production to a greater rate faster, and it's a very certain outcome. It's not something that's a technical risk.
Mm-hmm. And maybe talk to a little bit about the low pH versus alkali leach for ISR mining. Most of the world already does what you plan to do, but why did you become the first U.S. company to switch over to acid leach?
Well, we were looking at what our global competitors did and the effectiveness of the low pH. But we also were looking at the reality of the Lance project as it was operating as a leach facility. We recognized that there were some uranium minerals present in our formation that perhaps are not so common in other deposits around the United States, but those uranium minerals were not amenable to the alkaline chemistry. So as we were mining with the alkaline, we were not getting the expected recovery rates or even the average recovery rates of an alkaline facility. So we started testing low pH, and we found that all of the uranium mineral was amenable to the low pH chemistry. And then we developed not just laboratory tests, but field demonstrations to show that. So we did a demonstration in mine unit 1, an area that had been previously mined to depletion using the alkaline chemistry, and we put the low pH chemistry to it and successfully recovered additional uranium at very good grades. It showed that the laboratory tests could be applied in the well field. And then we went out and added a little pilot area on the perimeter of mine unit 1, which had never been mined by alkaline methods. And we did a field demonstration where we not only recovered the uranium and got recovery results comparable to the laboratory tests, which is around 90%, or in the laboratory we can recover 98-99% of the uranium. But we also then loaded that on resins, and we had those resins processed and generated dry yellow cake. So we think we've done a real robust job of technically de-risking, but the bottom line is that we will get a very much higher uranium recovery rate from our project using the low pH chemistry.
Mm-hmm. And you've also started to design larger header houses as part of this project as well.
That's right. The development of header houses, which are a subsection of a mine unit, It's a very big thing, because a header house is, the economics of the header house is how many pounds you can put under pattern in that area, and weighed against the capital costs of a building, electrical, plumbing. The more wells we can fit into a building, the more economic it is. But there's another significant, actually technical answer for why we can build header houses to a larger scale now, and that is alkaline chemistry is generally relying on a two-phase flow. We add oxygen gas into the production, the injection stream, and we have to carry that gas in solution to the injection wells. The further you go out in a pipeline, the more pressure loss you have, and the more likely that the oxygen gas will separate back out, and you'll be trying to overcome a two-phase flow problem, gas and liquid. Those wells, those pipelines airlock. In the acid, the low pH chemistry, we don't have a gas that we add to the stream. The chemistry is a little simpler, and therefore we don't have two-phase flow problems, and we can go further from the header house. So we're building bigger header houses, and they'll be more economic.
Mm-hmm. And this also allows you to build header houses that are acid ready as well. So.
That's right. Mine Unit 3 will be the first well field that's built specifically for low pH chemistries.
Great. Okay. Thank you for that, Wade. So the Ross and Kendrick properties only account for about 40% of your 50 million pounds to date. Is there any room here to expand resources close to the plant before starting to move further afield and going after that 30 million plus pounds at Barber?
There's room, Dave. The Kendrick area is not fully in the measured and indicated resource category. There's about a third, 30% of the resources in Kendrick are inferred resources. Our experience has been very positive when we've gone and delineated inferred resources. We generally can convert those and upgrade the resource quantities at the same time. We didn't accommodate that in the model. We take a more conservative approach in our modeling. We say that inferred resources don't convert as well to pounds under pattern as measured and indicated resources do. And so we have a much lower factor for converting inferred resources to producible pounds. So there's certainly an opportunity in Kendrick to expand the resource before we have to go to Barber. But Barber is contiguous with Kendrick, and portions of it will be pipelined to the current plant. And then portions of Barber are 15 miles away from the current plant. So we'll build a satellite plant at that point.
Okay. Do you still think you'll use a satellite plant, even though maybe acid can be piped further?
Yeah, a satellite plant has economics that are better than pipelining for probably once you get more than 5-6 miles from a plant. A satellite plant becomes a thing. So, in the south of the project, in the long term, Barber will be brought into the production permits, and we'll build a satellite plant in the southern end of the project. The northern end of the project, because Barber kind of wraps around from north to south, the northern end we could probably all pipeline back into the current plant.
Right. Okay. Now, your ISR plant license capacity is 3 million pounds. So does that really foreshadow another plant expansion down the road, especially when you're looking at expanding Kendrick and Barber comes into play?
Really, it's a Barber expansion that'll bring us closer to 3 million pounds. If things are rolling along well with Ross and Kendrick, and the uranium markets go where we think they will, we can expand the back end of the plant to be able to bring resins in from the satellite plant in the south. 2 million pounds per year production rate, or 1.8, which is really where we settled, is a very sensible and executable production rate for Ross and Kendrick combined. But yeah, we could add a satellite plant to the south while continuing to operate Ross and Kendrick, and then add another 1 million pounds of production out of the Barber area, and then expand the back end of the plant to accommodate that as well. But you don't want to spend that capital now until it's really a real part of your plan.
No, exactly. So, and speaking of capital spending, you mentioned additional cash is going to be needed to fund the larger plant. And you mentioned in your press release today, you're going to need about $120 million for CapEx. Now, I think about 70 million was already scheduled for stage 2 expansion anyways. And you did mention the loss of revenue from toll milling. Could you perhaps remind us how you might go about funding the build? You said you do have some time here.
Yeah, certainly. Well, what we've guided really is in net, and that waterfall chart that I shared in the presentation showed that in net we need an additional 95 million or thereabouts to keep the company healthy, to have all the capital expenditures and the operating costs that we need until we're sustainably in a positive cash flow position. So, and this is a corporate requirement, not just a project level. So, but Peninsula's flagship property and really our only project of significance is land. So it's appropriate to talk about corporate level expenditures rather than just project level expenditures. What we gave you is a fulsome disclosure of capital requirements. Where will we get that? Well, we've already initiated some conversations with some debt sources. We'll certainly look for support from the equity markets along the way. But I think that, debt becomes a much more viable means of funding a company when you're in production and or close to it. And we certainly have the contract book for future sales that supports a debt structure. So we have a good runway before we need to raise money with our current cash and with our uranium inventory. We have time on our side to think this out and to start to evaluate both debt and equity funding mechanisms and what combination of debt and equity the future might bring.
Yeah. And I think hopefully uranium prices continue to rise. I'd note costs are up about $5 a pound since your August feasibility study, but prices are up over $10 during the same period.
That's right. And it's important to know, you're right to point out that our cost is creeped up a little bit, but we did a definitive feasibility study a year ago, August of 2022. And now we've updated our life of mine study with current dollars. So all of our expenditures are current. We've updated where inflation has taken its toll, and the price of contracting drill rigs, in the cost of labor, in the cost of chemicals. All of those areas have seen very real escalation in the course of the last year. And those escalated prices are reflected in our newly released model. So too is a reflection of, that uranium price, as you said, is up. It's up over 10% from a year ago. So that bodes well for us because price of uranium and really the price we realize in our contract book is moving with inflation. So yeah, the dollar amount looks a little larger on costs, but it also looks larger on revenues.
Yeah, perfect segue into my next question. You have almost 5 million pounds contracted right now over the next 10 years, escalating from $55 a pound. Do you have support for the new plan from your existing customers? And then I guess sort of a secondary question here, does this construction period give you additional time to find some further offtakes? And would you have a target price in mind, considering we're at spot near 60?
Yeah, absolutely. Right. Spot today is approaching $60. Our all-in cost on the project was $50. So, I've always said the next contract that we sign is going to be better than the last one that we signed. And the market is bearing that, for us. Yes, we have objectives. We want to make sure that when we contract pounds, that long term those prices will be profitable for the company. And I believe the market is quickly moving into that position. So we have a good marketing presence with the utility groups. We've outreached to a number of utilities that we don't have contracts with, and they're interested in our story and how our production profile moving forward will fit into, feeding their needs. I think it was really important for us to share what that production profile is, and that is in the presentation. Utilities see that we're aiming to be a producer of 1.8 million pounds a year, and we've committed 400,000 or 500,000, maybe 600,000 pounds a year into the markets right now. So we have a significant amount of future production that's uncommitted and could go to the right utility for the right price.
Right. And we're both heading off to the World Nuclear Association conference next week in London. So I'm assuming you already have your meetings lined up with nuclear utilities.
We have a full slate. There's a lot to talk about for Peninsula Energy, and we're excited about the prospect of sitting down with the European utilities over in London, but also refreshing and updating our story with the U.S. utilities, who we have many more opportunities to sit down and talk to.
Mm-hmm. And with 50 million pounds, that's nothing to sneeze at. That's a pretty large amount for a U.S. project.
I've always said, that's what's most attractive about Peninsula and working at this project is the scale of the project. There is no other U.S. project with that scale of resource, that size of project footprint. It's a very exciting thing. You drove with me north to the project site from the interstate highway where we tie in. It's a substantial drive from where the project starts to the plant facility, and it goes on further to the north. It goes several miles further to the north, or kilometers. It's a big project. It's worthy of patience. It's worthy of investment. It's worthy of getting right, and that's what Peninsula set out to do all along.
Right. Okay. I guess to wrap things up, Wayne, just more of a general question here about the U.S. uranium reserve. And, Peninsula participated in that earlier this year. Very good prices you achieved from that, higher than even current spot, like at 60. What are you hearing about that purchase program continuing next year and going forward? And how might that benefit?
As a member of the Uranium Producers of America, we're always lobbying to make sure that the U.S. government takes care of its needs. Uranium, should be described and defined as a critical mineral, but it slipped off of that critical mineral list under the current administration. If it was on the critical mineral list, it would get a little more attention. But they established the reserve. We're looking at consolidating that, the purchases that they made last year or earlier this year with other uranium reserves the government possesses, and they're looking at how inadequate the current level of uranium reserves are for the U.S. If they were actually needed in a time where the U.S. was cut off from global markets. The nuclear reactors in the United States consume 50 million pounds a year. The uranium reserve bought 1 million pounds. They need to do a lot more buying, and we'd be happy to support that. But we can see that coming down the pipeline. Geopolitical situations around the world are simply pointing to the need to be more self-reliant as a nation, and maybe more importantly, North America can be much more self-reliant than looking at the Eastern Bloc for all of our uranium supply.
Great. Okay, well, we'll wrap it up there. So thank you very much, Wayne, for joining us today.
My pleasure. Thank you, David.
Thank you, everybody, for tuning in. Our next webinar is on Wednesday, September 6th at 2 p.m. Eastern, and Lena is going to sit down with NV Gold at that time. So have a great day, and thank you for supporting Red Cloud's webinar series.